Welcome, everybody. If you guys could let me know you could hear me, I'd appreciate it. All right, so we are good to go. Give it a few more seconds here, and then we'll get into it. All right, so I want to welcome everyone to this week's Principles webinar. As always, I want to start it off by welcoming those that are new to Trade ATS. Happy to have you with us. Wanted to start off by letting you guys know what this webinar is, also what it isn't. So to begin with, what this webinar is, it is an educational webinar designed to get you to understand the indicators that we have here that are unique to Trade ATS so that you can come up with your own trading ideas and you can navigate the markets in a good and professional way. What this webinar is not is it is not any kind of financial advice. We are not here to tell you how to invest your money at all. We will talk about trading ideas, and what you do with that information is 100% up to you. It should be used for educational purposes only. Just want to make it very clear where we operate. So that all being said, again, I want to welcome you guys to the webinar. And so if you guys have any markets you'd like me to take a look at, you could type those in. I would need your entry time frame. I need your supporting or your directional bias time frame and some context about what it is that you want me to comment on. And I'd be happy to do that. But one thing that I want to do to kick this off is I wanted to spend some time talking about entries and exits, but basically, when do you pull the trigger? Is basically what I wanted to cover, because it's not that could be a bit of a complicated question to answer depending on the situation in the market. And so I kind of want to just spend some time on helping you guys understand, particularly those of you guys that are new, when you should be trading, when you shouldn't be trading, really is kind of the biggest thing, and when it's okay or safe to start testing out a market. And I know we have a lot of people that come to Trade ATS from the traditional landscape out there that is pretty much preaching, short-term scalping, trade high leverage, grow your account, double your account this month, like all these big promises. Of course, they pretty much never come to fruition. But when you come from that environment, you're expecting what that environment says to do, because you just think that that's the way the industry, that's the way it all is. And I know this because that's where I came from. I know I'm like, if I'm going to trade, I need to be a scalper because that's what everyone apparently is doing. And if I do that, I need to use these indicators and I need to use this technical analysis and this, and because that's everything that's out there, right? So when they come here, they're like, where is the buy and the sell signal? How do I get in? Where is the rules checklist? They're all looking for that. And the great thing about ATS is that it conforms to all market environments and you're able to come up with very creative trading ideas that others can't see. But the hard part about ATS is you need to actually think through each situation. You have to understand the key concepts and principles behind the market, and that is what tells you whether or not you should be trading. Flat out, there is no perfect checklist we have. So if you're looking for check this box, check this box, check this box, and my trade should win, you need to do more than that. It's not going to be that simple. And I hate to break it to you, but pretty much nothing is. Even if it's advertised that way, everything is going to take some understanding and some kind of, it's almost like a sixth sense you need to develop to be able to understand and feel the market over time. That's what will help you understand, do I need to keep staying in? Do I need to get out? Is the market really shaping up the way I thought it would? It helps you really feel the market. That's what you need to develop over time. So that all being said, what I want to do is I want to walk through the process of understanding what a trade idea looks like, and then leading to where should I enter once I've collected sufficient information, and how should I manage that trade. And the idea behind this is to just kind of like just get you guys to the next step past the beginner strategy. So the market has obviously been pretty contracting here on the 30-minute to the daily. We had a nice run coming up through here. Actually had a couple of nice runs, one up here, one down here, one up here. So basically traded into a box. We're now breaking out of that box here, at least on forex.com data stream. We have the box, so that's good to see. So how do we come up with a trading idea? That's the first thing. We have the basic strategy, and those of you guys that follow this, you know that I basically want to identify a directional bias, and I want to trade opposite according to value for my entry on the lower time frame in the trend. That's the basics. But the key to understanding or to having higher probability in your favor on whatever you're doing, in reality, starts with forecasting the higher time frame. You need to understand what the key levels are on the higher time frame, and you need to decide, you need to kind of make a choice over what the next handful of candles are going to look like on your higher time frame. For instance, on the daily right here, where we shifted, we traded, we gapped up through the ATS trend line, made that transition, and settled right here. Also, settling above this prominent fair market value. So you have a confluence there. Right here, right here. So when this day opens, right here, there's a good chance that we're going to continue to go up for at least a few more days, because it's fresh in the trend change in the trend change direction right there. It's fresh, right? So you'd be looking for long positioning, because we're forecasting that this daily is probably going to give us at least a few more days above this line. We don't know how aggressive it's going to be. We don't know exactly the time it's going to take to play out, but we know that it's likely to, the predominant movement is going to be up. Based off of trading above fair market value right here, it's starting to push, and our trend change on the ATS trend line. So that's the beginning of a trade idea, is figuring out where do I think my higher time frame is going over the next couple of candles, potentially, with decent probability. So you start there. Okay, so once that happens and you forecasted the higher time frame, then you look at the lower time frame with through the lens of the directional bias. Meaning the directional bias at the end of the day is, where do I think the next few candles on the higher time frame are going? Now, keep this in mind. We have simplified it with the ATS trend line. So it's just like, if I'm trading above, then it's going up. If I'm trading below, it's going down. Okay, we've simplified that. But at the end of the day, if you want to get really creative, it's always, your directional bias is always, where do I think the next handful of candles are going on the daily? So there's an argument to be made that as we had this aggressive move up, we came through this previous institutional level right here, we dropped back, we had a small candle, and we kind of were building around that. At this point, you could have come up with a directional bias conclusion that it is going short based off of this as a reaction line, particularly as this candle started to take off. Now that technically would be above your ATS trend line. But the point is, it's a forecast that you're making based off of a key level. Same thing right here. When these candles traded up right here, and they traded up to this previous institutional level with these wicks right here, this is technically above the ATS trend line, but based off the reaction to that level from right here, you can decide my directional bias is now short, which is what played out there, based off of that as a key informational clue. This is more advanced for people that have been watching this longer. I would suggest you just follow the line, because you'll still get plenty of opportunities. You notice that, like, even that right there, yes, you could start trading short based off the reaction from this line, but you would have maybe got something out of here that was kind of choppy, but if you waited for the confirmation getting under the line, you still could have got something right here. So, you didn't miss out too much. And this whole thing up here, it confirmed over the line, there was still plenty there. But my point is that the directional bias is, regardless of how you do it, whether it's ATS trend line or it's a bounce off some prominent level, whatever it is you deciding that the next 2, 3, 4, 5 candles are likely going to go overall in this direction, whether it be up or down. Okay, that is, at the end of the day, the pure form of directional bias. Again, we try to simplify that with ATS trend so you don't have to think too much, but that's, at the end of the day, is where's the higher time frame going. Okay, so going back to our example over here, where we had this transition, this right here is our first established box on the 30-minute after we made the jump. So let's say that after this candle right here, coming into this second candle, we have now classified the market as being in a long directional bias, meaning we are only looking to buy. That is it. No selling. So if that's the case, then you're going to look at all framework on your lower time frame through the lens of that long directional bias. So the moment that this box is made, we're trying to figure out how is the third market phase, which ended up being over here, going up, how is the third market phase going up? And keep in mind, we don't see any of this. All we see is this. That's it. We have a box. How is it going up? That's all we're thinking about. And that's what simplifies your decision making. Now, it may go short, and we'll get into that in a second. But this is where we are, at this point, we are closed off to trading the market in any other direction other than up. We know that we have fair market value established here. And so if we trade above fair market value, if you buy right here, you're risking going back to value and below. So this all is risky to go back to this, to fair market value. Trading down below here is less risky because there's a higher probability we're going to go back to value right here. And that's all we're really initially looking for, is getting from your entry below fair market value to value. That is the magic in the ATS approach, is having a very high probability that we're going to, wherever you enter and whatever the stretch is, the deviation between where you enter and fair market value, that you can, with a pretty high probability, bet on the fact that you're going to return to that level. That is your money in the bank. That's your bread and butter, here to here, here to here. The third market phase, which is this, is bonus. And you want to try to catch those, but at the end of the day, you want to try to make the entire model work, getting base hits, here to here, here to here, here to here. And depending on how it works out, and this will come over time, you will hang in for some of the third phases. Particularly in this situation, you got to think about, because you were so early to the transition, this is where you might want to wait for the third phase versus up here. If we go all the way up to the top of these candles up here, we've already had a big run. So the probability of each one of these boxes not going into, or going into an extended pullback, is going to be more and more. So you need to also judge where you're trading. Is it early in the trend? Am I on the first couple of candles after the transition? Or has it been going for 4, 5, 6, 7 candles? And it doesn't mean that you don't trade it, but it means that you start adjusting your expectation. This is grade A trade positioning. This is grade B, grade C, whatever you want. It's later. And so don't expect you're going to continually get big third phases, big trend phases at the top of a move on your higher time frame, or after a good amount has gone by already. Keep that in mind, okay? All right, so going back over here. let's recap where we've been so far. Finding a trade and knowing when to enter. We're not going to enter until we feel good about our prediction on the higher time frame, right? Everyone with me? Can I get some thumbs up? That's the first step. Cool. So first step is making sure that we have done our forecast. Second step, when we're actually entering, is trying to decide to get a good deal for that minimum upside. That is our marking out fair market value and trading, in this case, because the market's going up, below that fair market value. Okay. Now, we got a question into support not too long ago saying, well, if I get in here, the market, sometimes it just turns around on me or it just keeps going. As long as the market stays above fair market value, it's only a matter of time before it comes back to this level. So even if you enter, let's say, right here, you're just a little hasty and you get in right here because you're like, hey, it's below, I want to trade, I'm a trader, I got to get in a trade right away. And this is it. I'm below, Wade said I got to be below, so I'm in. Fine. Good, at least you're below. At least you didn't do it up here thinking you're missing out, right? So you're in below, and now you're like, oh, this doesn't work. What's going on? Oh no, it's going against me. Forget this. Okay, and maybe you're started right here with your stop loss right here, and you get stopped out. And then you put it again right here, and you get stopped out again. You know what I say about that. Tight stops will give you, it's death by 1,000 cuts. So the question is, if you enter right here, because it's the very, very, very first place that you could get in, and you just want to be in, nothing wrong with that. How do you know when it's completely done, when you should actually just totally get out? And the answer to that question is based on clues of invalidation. When you decided that you wanted to trade right here in this fresh transition, you need to also come up with, what does this look like if I'm wrong? And so based on these three candles, we have a few things here. You have this fair market value that's holding. You can see that it's very sensitive at this point. It's holding those wicks right there. It's holding this wick right here. So that's a good line. You can decide that, say, hey, I pretty much don't want to see the daily aggressively trade through that level. Okay? So in that case, stop loss could be down in this range, down in here. Okay? And that, just so you guys know, that's really where you want a lot of your invalidation clues to come from, is your higher time frame, because this is ultimately what's going to pay you right here, is the probability that the higher time frame is going to keep going in that direction. So you want to look for places where that invalidates. Okay, so if you're looking at that level, and remember, you don't want to put it at the level. Like right there at the level, that would have been basically right here. This would have tagged you out at the level. You want to identify the level, and you want to stick your stop down here. Not that you want to use that stop, but you want to have it interact. If it's going to, you want to have it interact with the level, because chances are it's going to come down here. And even if it interacts, it could get whippy and then take off. And you don't want to get caught up in that noise right there. The key with ATS and managing risk is identifying the level and then giving it plenty of room around the level so that you can watch the reaction. That's key to remember. So if the level is right here, in this case, it came down, it just kissed the level right there and bounced. Beautiful. But if the alternate here, and again, let's go off, if you're entering here, you got to be prepared for this drawback, because this is the key level that's keeping your higher time frame intact. You might be like, well, I don't like that. I don't want to go that far. That's the deal, though. We don't make the architecture in the market. The market sets the parameters you have to work with. If you don't like this, you don't need to trade it. You can wait till it's closer. And if it doesn't get closer, wait till something is closer to your invalidation level. That's your job as a trader, is to trade when you have clear understanding and when probability is in your favor. And so you might be like, you know what, I'm going to protect capital because it's not close enough to my invalidation level. I'm going to sit on the sideline. That is your decision to make. Okay? So if you did enter here, it's going back against you, and this is your invalidation level. At this point, you're like, okay, I'm there. Your stop loss is down here at this point. Yeah, kind of wide. I get it. Kind of wide. But the goal is not to use a stop loss. The goal is to see if it does come down to the invalidation level. You know, you got one small position here. You can maybe put in another one here because now it's even closer to your invalidation level. And then let it interact. Let's see what's going to happen. What you wouldn't want to see here, if you had a position in here, is you wouldn't want to see this. Right there. If it does that, you want to kill it. You're not waiting till the stop loss here. You're not waiting for that because it's holding that level. You're establishing price below it. And at this point, you know, you're probably starting to close the day or opening a new day under the level. That's kind of a telltale sign is if you open in this case, a new daily candle above or below your invalidation level. That's where you really got to start being careful. Okay. So anyway, the key with risk management is clearly identifying your level of invalidation. And if you don't have one, then there's probably not a trade there, or there's not going to be a good enough understanding to figure out if this trade is working out or not. So as we can see, all these positions did end up coming back around, back to your fair market value, which is that gravitational pull. This is the line right here that sets us free. This is how we see through the chaos, is that line. Through all this dirty movement that people are buying, selling, buying, selling, buying, selling, what's it going to do? They're chasing the market around. We have this grounding us, and we have that line right there grounding us, knowing that as long as the trend stays up, that will be a highly gravitational point. Okay? So risk management is based on the level of invalidation. I want you guys to get that. Every situation is going to come with a different framework. Doesn't change the overall basic strategy that the trend is going up and we want to buy below fair market value. But your risk management is dependent on this, and it's dependent on this. And if you want, you could even look at previous prominent framework that coincides with your higher time frame. You can see that we had a nice master pattern activity around this box. So you could look at this as a key level right there. So stop loss is going to go under that level. The goal is getting significant framework between your entry and your stop loss. I'm going to repeat that one more time. The goal is getting significant framework, meaning ATS trend line, maybe institutional level, maybe a previous, even a previous fair market value. The goal is getting that stuff between your entry and your stop loss. Why do we want to do that? We want to do that so that we can see the interaction. Why do we want to see the interaction? We want to see the interaction because it gives us a clue whether or not our trading idea is going in our favor or not. How it respects the framework is your clue to the future of what it's likely wanting to do more of, which is increase in value or decrease in value on the price. Everybody with me so far? Does everybody understand why this can't be a perfect checkbox system? There are key principles like trading in trend, understanding fair market value and where you're positioned. But does everybody understand why I can't give you a checklist that says set your stop to 20 pips, set your limit to 40 pips, don't trade, all that stuff? This is adapting to framework that the market sets. The three market phases are always going to be happening. That's a rule. But the time it takes for them to fulfill, the size of the expansion legs, the number of the expansion legs, all those are variables. Doesn't change the sequence. but it changes how we need to adapt and how we need to craft risk management. And it all comes down to identifying a trade idea and identifying the invalidation point. Where does the idea fall apart where I don't want to be involved? So most of your trade is going to start over here. If you see something interesting on your higher time frame, you see a fresh transition on the ATS trend, you see a very clear reaction on institutional level or a liquidity line, whatever it is you're using, that's where you start to develop your expectation. At the end of the day, your ability to call correctly the next 3 or 4 or 5 candles on your higher time frame is the skill that you need to develop. Over here, if you do your work over here, this all becomes much less stressful and much easier. Cool. So let's go up. I want to look at the top of this now. This is the early place to get into a trend. Let's talk about up here. After you hesitated because you didn't believe it down here, and now you're getting convinced of the trend up here. Classic, right? What do you do now? Let's walk through a really late, not ideal trade opportunity just because you got to get in, right? So now you're up here and the market's done this and you've missed all of it. And now you're convinced of the trend. So here's your box finally letting you in right here. Still, this is all trading above the ATS trend line. So still long. No, and there's not a problem trading this long. Again, we need to start thinking about our expectation. Do I think that this thing is going to just continually keep blasting off to the upside? No, I know that particularly like this candle right here, that candle sucks a lot of people in to buy. That also stops a lot of people out that maybe had shorts in above this level right here that were shorting the market. That's why we see that. So it's absorbing that liquidity, sucking new traders in to get them to buy the market. A lot going on there. So as that happens, we get this box here. The rules are all still the same, or the basic philosophy. We have a fair market value, and we are looking at it from a long directional bias, but we are also looking, if we're going to trade it long, we need to decide when does this get invalidated. In this case, where this box is built, which is right here on this candle during that day, right? That box is way over the 50% mark of the previous candle, and it is very extended from the ATS trend line. So when you decide to trade this box, and this is a big mistake that I see a lot of you guys make, or it's not, I wouldn't say it's a mistake, but it's just, you guys will send emails and be like, how did this not work out? And it's like, well, you're trading a box that is inside of a major extension away from your trend line. Where's your invalidation point, right? And so you can look at this. There are some key levels here that you could use, but let's just say the ATS trend line, because I know a lot of you guys are using that, which is good. From a perspective of the ATS trend line, you're pretty far away. So you need to decide, do I want to get involved with this, or do I want to wait for it to trade closer to my invalidation point if that's my level, right? Or let's say that you're using one of these two institutional levels right here. You're trading that and you're hoping that we're essentially going to, trade inside here, and keep going up from these levels. That's fine. So if that's the case, you could use those levels. And also what you can do, if you are in an extension, this is where you can really rely on past framework. Ultimately, the best trends, I'm going to draw this out real quick. The best trends are we're going to do what we call value stacking. That's where you have fair market value expansion lines headed up, and you're getting stuff like this. And you can see that these points right here are holding the previous fair market value, holding above. That's what we like to see. So right here you can see we went through this big expansion on the grade A situation. bounce off fair market value. Here we are, bounce off fair market value. Now you see that right here, which I was going to get into here in a second, but this is the inverse is happening. We've returned to fair market value, but now, we're starting to go away. Also notice that we have value here, and now we're value stacking to the downside. And look at, now we're not only value stacking the downside, but now we are not wanting to increase in value above the equilibrium. Clues, it's all clues, guys. There is ideal behavior that we would like to see, and when it doesn't behave ideally, we need to ask the question why. That's how we figure out whether we should be in this trade or not, and what we should be doing. So going back to the example here, you need to decide whether you even want to trade this far into an extension. If you do, you need to figure out your position sizing that's appropriate for the probability associated with this opportunity. Let's say that the probability that the third market phase goes to the upside here is, we don't know the exact percentage, but let's say it's under 50%. So that means you have a 50% probability that it's going to go, the third market phase is going to go the other way, which is what ended up happening here. So if that's the case, what position sizing should you be using? Where's your invalidation level? In this case, I would have looked at these levels right here, probably this box in here as your risk level. And outside of that, look for some corresponding framework. Obviously, we have this here. So stop loss in this case, realistically, is probably going around here initially. So that would be the ultimate invalidation level. So let's say you enter right here. Let's say you enter again, small position right here. Let's say you miss this one and then you enter again right here because now it's like, okay, it looks like it's bouncing. Looks like we had a bit of a market structure change with these highs, with those candles, some kind of minor detail in there you could be looking at. So you buy again right here. And then here we are. Okay, this right here is a clue. Remember, the market has value right here, and it only increases in value or decreases in value. The interaction we get with value tells us what's happening. That answers the question. This right here is a clue right there. Is that increasing or decreasing in value? And based on your positioning, what would you like it to do? You would like it to increase in value. So when you get stuff like that, combined with the fact that you are at the top of this skyscraper looking of a candle, this is where you need to maybe lower your expectation. And you know what? You're probably not getting out right here. You're probably going to give it some time, but you're probably going to end up getting stopped out right here with a little bit of a loss or a break even. That's fine. Do you immediately get back in? Not necessarily. Because you've given this a chance to revalue to a higher price and go through, and it's not doing it. And based off of all the compiling evidence that we have this clue that's happening, you're at the top of the building over here, maybe what you want is another third market phase is just likely not going to happen. Maybe it does later, maybe you miss out, but that's fine. You know what? Another grade A, these ones are not the best to trade. So anyway, all this evidence compiles and it tells you what you should be doing. And just because your stop loss, let's say, is down here, again, the goal is to not use a stop loss. The goal is to use our brains. And after this happens right here and we get this clue, the goal is to use your brain and get out right here. Don't walk away and say, I'm going to let my stop manage it. Oops, I keep hitting my keyboard. Okay. Back to here. Okay, so that's a goal, guys. The goal is to watch the clues, to give room for the clues, and to make the decision consciously. Now, a lot of the other systems and approaches out there will tell you, just set your stop to this and then set your limit to twice that or 3 times that and walk away. That's wonderful, but that is a robotic system. And I understand why everyone wants that, because it's like it takes the emotion out of it. And then I'm going to see if the system has a winning expectation over a large number of trades, blah, 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 blah. Then I'm going to do that. Okay, that's what everyone is doing. That's what all your competitors are doing. How is it working for them? They're all trying to find that. What we're trying to do here is we're taking the best of that. We are trying to lack of a better term, we're trying to automate our decision-making as much as possible. We are trying to systemize the base criteria we're looking for, but we're also trying to use our brain to not have to take losses more than what we need. And we're also trying to maximize our gains when we can. So there's a discretionary element to what's going on. And ask any great trader, there's a huge part that is discretionary for most great traders over time. It's based on experience. It's based on knowing what they should do as the market unfolds. So keep that in mind, guys. It's a big part. And that's why a lot of my training that I'm going to give you guys is just teaching you how to think with this stuff. Some markets will be easier to read. Some markets will be more difficult. The key that you guys want, the number one word that you guys need to be thinking about when you're coming up with a trading idea is clarity. You're looking for clarity in your setup. You're looking for clarity in your expectation. How does it work? How does it fail? Key levels, understanding. Clarity is what is going to work in your favor. If you're not clear on the key levels, there is no trade because you have nothing to manage it by other than your emotion, which is usually not the best thing to manage a trade by purely, right? You guys need to trade smaller position sizes because a lot of your trades are going to need a big range to let you read the story. That is a key thing. If you want to see your win rate increase, you need to be willing to trade smaller so that you can read the market appropriately. If you are trying to call your entries from every little rotation inside here, you're trying to trade every little pullback, this, and put your stop right here, and you're trying to trade right here and put your stop right here. I know why you're doing it. It's because you want to scalp and you want to use bigger leverage so that you can do what everyone else out there is telling you. But I'm telling you, you're going to get death by 1,000 cuts. Yeah, you will have some trades that you call right and you knock it out of the park and it feels really good. Believe me, no one knows more than I do. I get it. But your ability to use the trend in your favor, use that forecast, your directional bias, and then put your positioning in the market with wide stops so that you can watch clues happen, watch that activity play out, watch if things are going in your favor or not. Watch those things. Your ability to let the book turn the page and give you more of the story, that is going to be what sets you free. That's the most important part here. Most of your competitors are unwilling to do that, and that is why they all lose. They will not loosen their grip on the dream of high leverage, quick scalping. And they will always feel that they are one strategy, one tweak, one more trading session away from cracking it. And they will do that forever. And that'll be it. Meanwhile, you guys are going to do the hard thing, the slow grind, the tough thing, small positions, wider stops. You're not planning on using them, but so you can read the market. And you're going to stack small wins consistently. And you're just going to grind your way right through all your competitors. Because they're going to be through 7, 10, 15 accounts, micro accounts that they've blown up trying to do the same thing. And you're just going to be stacking that progress year after year after year. Because you are willing to do what they aren't, which is hard work and patience and discipline. Anyways, I'm going to go through your guys' comments here. That kind of was long-winded. I apologize if I've confused some of you, and this might be not some of what you guys don't want to hear. I don't really care. I'm not going to change my message to suit what everyone wants to hear. This is the realities of it. I've been doing this now with 14 years. We have a pretty large data sample of a bunch of people coming in to trade ATS doing a bunch of different strategies. We know what works. We know what doesn't. This is the safest way to trade, the small positions, wider stop losses, so that you can see how the market interacts with value. The market only goes up, it increases in value or decreases in value. How it interacts with the fixed prices that are unique to ATS help us understand what it's wanting to do so that we can make a decision to stay in or to get in, and then to stay in or to get out. That's it. And the better you are at forecasting over here, the more trades you're going to win. Cool. Let me go through some of your guys' comments here. One sec. Okay, good question from Manuel. How does simplified mode affect this? Well, let's take a look. So I think a 1 month is a good reset period. Actually, let's take a look at it without that, because we're stuck in a huge expansion if you let it run organically all the way from back here. So this thing looks like it ultimately wants to go long just because we're settled above fair market value. So I'd say on the much bigger time scale, we're probably going to go long, but that's not 100%. But when you guys if you're using simplified mode, if you get into a huge range where you have, because it's not gonna reset until we get either below this order block projection or this one up here. So that could still be a little while. Then you can use a reset calculation. 1 month is good for the 30-minute. Even 3 months. The goal with simplified mode is to, we'll use 3 months for right now, is to just lessen the amount of framework that you have to take into consideration. All the boxes work together. They all work together as a family. This is a great example of this. See this box right here? You guys see that? And you guys see how we have the origination point here, and you have your expansion, price settles right here, and it goes into the third phase. See how clean that looks? The point of simplified mode is using the order block projections to find the inevitable big trend phase. So if you're someone that wants to find the really big third market phase, simplified mode's great for that, because you're always going to be trading to your biggest order block projection. And it's eventually going to get there. It takes more patience. You could be in the trade for a little while, but yeah. So anyway, that's a great thing there. But simplified mode, it's supposed to help you find much bigger moves, potentially take less trades, which is all good. Just give you more clarity for the full three market phases, versus if we look at this right here, very clean master pattern. If I go back and I take off simplified mode, same box right here, but now look at, we have a box, the main box right there. We have a box right here, box right here, box right here, box right here, box right here. Now these are all little mini cycles inside of the bigger cycle. And for instance, the trend phase on, get this a little bit bigger here. The trend phase on this box right here moved up. So there we are. We have one, first phase, second phase expansion, third phase going up, stops right here. The three phases associated with this box were nothing more than an expansion leg on this box right here. The trend phase on this box leading down to this box, and this box leading down to this box, both of these boxes, trend phases, were another expansion leg on this box, same box. So you can see it's cycles within cycles happening all the time. So You can look at all that detail, nothing wrong with that, but you have to look at the families of boxes. All these boxes work together to tell you one story. What is a trend phase on one box is the completion of an expansion leg on the other, and vice versa. That's the type of reading that we're looking to do. Everyone with me on that? Give me some thumbs up, because this is definitely an advanced concept. Cool. Three market phases is the baseline of all market price action. It's happening on every big liquid market, on every time frame down to the tick. That is the baseline foundation, and that's why we use it as the building block of the grid that we interact with. Okay? So the difference between simplified mode and regular mode is that level of detail. This, for an experienced ATS trader, you can see that this is still a valid level right here. You can see that that's still valid because we are still close in and around and interacting with that level. So based off of, like, when you're trading this box, when you trade this box right here, and we're not taking anything into consideration for your higher time frame at this moment. We're just talking about purely reading cycles. When you're trading this box right here, and you build this box under this previous fair market value, and it's coming up and it's interacting with that value right there, you can forecast what you think the outcome of this box is based off the fact that if you pick up that this whole thing right here, coming from up here, is potentially just fulfilling the next expansion leg down to liquidity down here. So that clue, by combining the normal three market phases with this box associated with what's still fulfilling from back here, can help you have a more accurate prediction of what's happening after this box. So again, for the more advanced ATS trader, you can deal with that level of detail. But also too, going back to our simplified mode, without that level of detail, the story still didn't change much. There's just less things that you need to ask questions about. Even through all of this activity, through here, through here, through here, the question has still remained, is the expansion phase going up or down from this point? The trend phase. And if you are trading this, the one part of that question was, how do you use that in conjunction with the higher time frame? Well, all through here, up through here, we were short on the daily according to ATS trend. So right here, it actually doesn't change. You get some much bigger cycles, but it still is the same principle. We traded down below. Do you want to sell down here in a downtrend? Nope. You want to sell up here, above fair market value. But the cool thing is that you don't have the extra noise of extra boxes in here. So you know that basically this is overvalued right here. It gets back through. Because you don't have that extra noise, you could really aim for the bottom right here, because you're working some very big expansion leg cycles. So this is why I like simplified mode, because it could lead you to a much, much bigger profit. Even when you're trading the expansion legs, they're usually pretty meaty, like they're big. So same thing right here. If you're looking at this box through the lens of the directional bias, we don't care about going up. You're selling here, you're selling here. When you get down through here, you're looking to get through swing low liquidity down here. And another rule of thumb, guys, too, for profit management, we didn't get a whole lot. We spent most of the day on risk management. But for profit management, the rule of thumb is when we get to value, particularly when we get through value, then you really don't want to see price settle above back and keep going. So this was like kind of right on the border. That would have been a little bit hard to navigate. But basically, once you get through fair market value, this is its chance to keep going. So you want to go from here to here. That's it. And then you want to give it the opportunity to trend down in this situation. If it gets back above, starts holding, kill the trade. Remember, the interaction with value answers the key question: is this market increasing from this level or decreasing? We are trying to make a prediction. Every box that you get, we are trying to make a prediction, whether it's going up or down. We are using the trend to give us a starting point to understand the probability of whether that trend phase is going up or down. We're using the interactions with fair market value to help us discover what is happening. And we're using the key levels for our risk management, our invalidation points. So I think I covered everything. Does everyone here understand now? It's not super straightforward. It's not a checklist, unfortunately, but there are certain parts of it you can make a checklist to make your life simpler. But the pure form of understanding or creating a trade idea is forecasting your higher time frame, a handful of bars, however you want to do it, and then finding the framework on your lower time frame that helps you explore whether or not that's playing out. And you find your invalidation point and your validation point. And that's it. That's how you make trading ideas. That's how you know when to get in, when to get out. The thing to understand is that I don't have a oscillator or something that's going to show you, the tip tops of these candles where you need to pull your trades perfectly, and get in. And I've tried to pair this with different oscillators and RSIs and you name it. Thing adapts to everything. You'll have some that are dead on and some that aren't. It's just another decision point. So at the end of the day, I'm here to tell you the good news and the bad news. The good news is you can have very high win rate, understanding fair market value, understanding overvalued, undervalued entry in trend. The bad news is I can't tell you whether or not you should pull the trade here, here. You're going to have to just trust in the trend, trust in your invalidation level, and get in. Sometimes you'll nail it here. And you'll be like, awesome. Sometimes you'll go here and you'll go on this ride. That is where smaller position sizing and larger stop losses still keep you a winner. And if you don't like that, if you're like, well, I don't really like that side for my minimum upside, that's fine. Keep in mind that a number that you have to work with, that you could also calculate risk by, is your deviation. If you enter right here, you can measure exactly how far you are to fairly valued price. In this case, basically 39 pips. If that's the case that you enter right there, your 1-to-1 is up here. So if you do want to work off of ratio, and you would never want to trade less than a 1-to-1, you can just simply set your stop loss at your 1-to-1 risk based off the deviation from value. Ideally, this one actually is not bad because your 1-to-1 risk is the same here coming down, and notice that your 1-to-1 is above previous framework. And what did I say before? You want to get a significant framework between your entry and your stop loss. Excuse me. Hang on, guys. Sorry, throat's a bit scratchy. I had to get some water. Okay, so that's something that you could put together. That my 1-to-1 getting back to fairly valued prices and my stop loss also has framework in between. Perfect. Now you got your 1-to-1 at least, and you got an invalidation level between your stop loss. You guys see that? And you guys see how this is all, you got to mold with it. Sometimes things will have these in place, sometimes they won't. It is your guys' job as the trader to wait until you have clarity and you have these levels of invalidation that aren't outrageously far away. It is your job as a trader to sit on your money until you get that clarity and until you understand what's going on and you have the clear invalidation level and you have a positive expectation of where that higher time frame is likely to go. That's your only job as a trader. Pushing the button is very easy. Anyone can do it. Most people cannot wait for the right things to be in place for them to make a winning trade. So, cool. Anyway, I think that we mostly covered it. Let me see if there's a few more questions. I know you guys had some markets in here. I apologize I didn't get to them, but hopefully this was able as well. Okay, Lucas asked, what risk-reward ratio are you using? Hopefully this was a previous from half an hour ago. Hopefully you have a clear understanding on this now. The risk-reward is based off of the framework. And some of the trades that you want to get into might initially start off with a much bigger risk than reward. But our goal is not to set it and forget it and leave. Our goal is to interact with the framework and figure out what the story is. The stop loss is really for catastrophic situations. We're not trying to use stop loss. We're trying to use our brains. So risk reward is going to be dependent on framework. And also you want to control your risk with position sizing. And if you think, well, what's the risk should be? Well, use the industry standards. Don't risk more than 1 or 2% of your account per opportunity, per trade idea. So if your stop loss has to be far away and you're going to trade one position, you need to make sure that, percent is less than your stop loss. If you want to go through that. And you could, as a trade goes in your favor, you could also add to it. You could do different things. You could finance some of your increased risk off of winning positions that you're already in. So again, it's all going to be dependent on the framework of the market. This is different from indicator trading because the indicators, I'm like traditional indicators because everyone's just focused on these. This is just, we're reading the book. ATS is an enhancement to price action. It's a backdrop. All we're trying to do is figure out the grid that the raw candle is interacting with. That's what ATS is. And sometimes that grid is favorable for a trade opportunity and sometimes it's not. We keep going down through here. All right, Manuel said earlier, I'm a bit confused on how to enter with so little lines and also the lack of framework for placing stops. Well, hopefully going through that, I explained it a little bit better. If there's too little framework, then you guys can, adjust your reset time frame. The tighter you go, if you're using simplified mode, the more framework you're typically going to get. Keep in mind, guys, that the goal is clarity. It's not to always be in a trade. Some of you guys that are new here, you guys think that I need to be in a trade all the time. Your competitors are in trades all the time. How's it working out? You guys need to be, you shouldn't be timid to get in a trade when the probability is there, when the framework is there. But you guys should not be upset about sitting on the sidelines thinking I'm not in a trade, even if it's for a week or two. If you're trading higher time frames, sitting out of the market is still a position, and it's protecting capital. And that's a lot of your competitors. That's much more than they can say that they're doing because they're in a lot of trades, but guess what? They're just flushing accounts down the toilet. So keep this in mind. If you fund a trading account and you didn't take one trade all year long, you would be in the top 5% of traders because you're not losing money. So don't think about your quantity of trades as an indication of whether you're being a good trader or not. Your quality of decisions is what makes you a good trader. The shorter time frames you trade, the more decisions you have to make and the more times you have to be right. The longer time frames you make, the less decisions you have to make, which is what I'm in favor of pushing you guys towards. So. Okay. Okay, Gary asked a good question. At what point does a box become a major box? So this is all covered inside of the training inside our courses under Methodology Mastery, but I'll just tell you real quick. So a box, they all start as gray, okay? As you break out, the box is still gray. The moment that it turns into a major box, it gets an expansion line is where you come up through the top of the box. So you need an expansion leg 1, expansion leg 2 coming through the high. At that point, you get a expansion line, and that's where it turns red. When it turns green is if you get 3 expansion legs coming down through here. Then at this point, the line turns green. And it's as simple as that. Let's see, Manuel asks, do you trade? I trade much higher time frames. So, and I know I want to make some more for the library. So I'm planning on doing that because I'm going to have some time out this year to do that. But personally, I did the day trading thing for a long time, varied success. I'm on it. And keeping in mind, guys, I also live in Southern California. So my days of getting up at 3 a.m. are over. I'm done with that life. So yeah, I trade higher time frames personally, and personally looking for like one good opportunity a month on the time scale I'm looking at. Also, ultimately just depends on what's going on. So that's just my personal flow. You guys don't have to do that, and I don't want to impose what I do on you. That's why I try to focus on the framework. That's what fits my lifestyle, and that's what I'm happy doing. So, and also too, I some higher time frame stuff in crypto. I've been doing more and more of that each year too. But my personal speed is much slower these days. I've done the crazy stuff. And a lot of my day trading, the stuff I tell you guys is from, it's from the craziness that I've experienced throughout my career. And I just know the highs and lows. That's why I'm passionate about it and telling you guys, I think that the best time frame for a lot of you guys that want to be active, but still want to like utilize the higher time frames, I would stay above a 30-minute for entry. For a 30-minute, hour, 4-hour, those are great places. It'll keep you relatively active, but you'll also find that your winners are much, much bigger. So that's the kind of stuff that I like going towards, and it works great for those of you guys that have families. I got 2 young kids. Well, they're getting a little older now, but they're young teenagers, and so they take a lot of my time and my attention. I want to be married to the screen. There was a point in my career, say 2013, 2014, when I was still, I was very much into day trading and trying to crack that. I would spend 15 hours a day sitting in front of the screen. Just crazy amounts of time. And so I'm just not about that life anymore. I think it's a waste, honestly. So, but yeah, I'm happy to make you guys more live trade videos, walkthroughs. They take a lot of time, and I have to be on them. It's not something, because I'm not doing pretty much any kind of fast day trading personally. I can't just film a morning of trading. I have to make them over the course of 3, 4, 5 days and edit them together and everything. So it's kind of a big hassle, but I will plan on making a good amount of those for you guys throughout the year, because I know they're good. But ultimately, guys, what's going to set you guys free is understanding the principles of the market. You guys need to understand how to make decisions using the 3 market phases, the base methodology, understanding the trend. That's really what's going to be the key for you guys to do this long term. And so that's my goal, is to make sure you guys understand when there's someone else not around to tell you what to do, what is the correct decision to make. Because that's going to be the majority of the time you're trading. There's not going to be someone around to tell you exactly what to do. And you need to be able to make a quality decision. So my goal is keeping you guys drilled down on that. Okay, Lucas asked you, do you open multiple smaller trades on a good setup, say 4 times 0.25% or single trade? It depends on the setup. If it's something where it's more the trend is more gone, personally, where I start going to like the 1/3 position or like 1/5 position. Just because I'm just like, yeah, I want to get involved, but I don't really like, I don't have high hopes. I think there could be something there, but yeah. So yeah, I'll lean more towards that. If it's more of a grade A opportunity, meaning like something like where we're like early to a new trend, like here or like right here, like that kind of stuff, that's where I look for like maybe half position or maybe one full position. If I find a setup that's close to the termination point, validation point. So I really just, I let the setup, the quality of the setup dictate how much I want to be invested in it personally. So these are the best times to trade though, is when you get that first run through for the ATS trend line, you get that first candle settling below, and then you find some nice framework like on that transition, that first, grade A opportunity. You look at like this trade right here this one had already started going down, but yeah, okay. So this one was already going down, but this one right here, this right here was right, like the ATS trend line is like right here. So, I mean, that's right up in the invalidation point. So if you enter right in there, your stop loss is, maybe up above here. Then you have some room to see, okay, does the market come up here and confirm? So in that situation, if you're tight with the invalidation level, then it's usually worth going all in on your position because you have the framework has given you the opportunity to do that. If you're far away from your invalidation level, then on whatever it is, then yeah, maybe do 1/3 position, 1/5, and end to it if it starts working in your favor. So something that you guys got to explore what you're comfortable with. All I'm saying is that you guys want to stay away from the big risks where you're like, I'm going to risk, 10% or 20% or 30% of my account to try to make, 100% on one trade. That's the stupidity from the day trading guys, that are telling you this is what you need to be doing. Stupid. I'm not going to mention the name, but this guy just drives me crazy. I feel like it's everything that's wrong with the industry. Talking about flipping $20 accounts. This stupid video. It was unbelievable how stupid this was. He's like, there's no reason to start with any more than $20. He's like, because then your first trade, you're gonna risk $5, and you're gonna have you're gonna risk $5, and you're gonna go for 20. And so it's all set up with this fixed, small risk, high reward, like that. And he's like, if you get the 20, cool, now you've doubled your account. And this is how you go. He is literally teaching people how to fail. It all sounds great. The story sounds great. But it is literally the doctrine that gets people sucked into this industry and gets them obliterated. And he justifies is like, if you just blow the account, it's only $20. That's fine. What he well knows is that there's desperate people coming into this business that are going to say, well, if I can do it with $20, why wouldn't I put $1,000 or $2,000? Because he makes it sound so easy. Why wouldn't I just put more money in? Because then, I could take my $1,000 that I have in my savings account, which is everything, and then I can double it or triple it over the next couple of trades and pay my rent, and then I'm going to be on my way to buying a Lambo like this guy. And of course, all you need to do is deposit your money with his preferred broker, which is the only broker he recommends using. Classic conflict of interest. They full well know that people are not going to want to just trade $20. They're going to trade $1,000, $2,000. Usually micro accounts are anywhere from like $500 to like $5,000. They're just going to keep the money because they're teaching you stupidity. And so it all sounds good, it all looks good, but at the end of the day, this is the stuff that destroys people. And if it were that easy, that the banks would have rooms full of traders doing this stuff. Instead, I make my case. They raise money, they build big funds, they trade long time frames, they build in and out of positions, and last time I checked, most all the money goes their way. So, that's what you guys want to do. That's a whole nother rant. I know we're getting long-winded here, but it's important because the industry and the way it's marketed makes you feel that if you're not doing those things, that there's something wrong with you, or that you're not getting it. But the whole thing is a farce. It's not correct. And if it was correct, there's a lot of smart people that are trying to do that, and they're all failing. So just look at the stats. The stats would be much higher if short-term scalping just worked on a mass scale. It doesn't. The people that make it work and do that stuff, there's very, very, very few. We have a couple of them in ATS, but there's very, very few, just because the black swan events and the slight mistakes that you make turn into big mistakes very quickly. The revenge trading, there's so many pitfalls, and all that stuff kind of goes away when you're trading longer time frames, because it just simply gives you time to think. It gives you time to let the market play out. You're trading less, you're paying less commissions, you're getting bigger moves when they work in your favor. It's just, at the end of the day, I would bet on a long-term trader 100 times over versus a scalper if I had to put my money with somebody. So anyway, just wanted to push that in there because I think it's always relevant. I know that a lot of you guys are fighting that temptation daily. I know, because I was that guy. I know. It's a huge temptation. What I'm trying to tell you guys is something that is slow. You're not going to blow your account up, and you're going to stack your capital over time, and it's something you could look back and be proud of over the course of the next year, 2 years, 3 years, 5 years. That's what I really want for you guys. So anyway, I think we're going to wrap it up there. Hopefully this was a good session. Hopefully you guys had some epiphanies with that. I apologize that the entries and exits are not a clear checklist. I wish that they were. And believe me, have I tried to find it. And if I could find it, I would have a robot that does this for me. The facts is that to really trade well, there's a large discretionary component to it. And I want to teach you guys how to read the market as it unfolds and what those key price levels are telling you. That's what ATS is all about. So that you guys don't have to wait to hit your stop losses. You don't have to just let it be mechanical. If the trades aren't working out, you get out well before it hits your stop loss. And I'll close with saying this. You'll find that a lot of your trades do have a much better than a 1-to-1 risk ratio, or at least a 1-to-1, I should say, even though your initial stop loss is far away, because you're not letting the stop loss manage it. You'll find that usually the market framework plays out in such a way that you'll get out in reality, not risking anywhere near what that original stop loss was. But you just have to trust the process, and you have to trade small enough so that you can actually trade the process and you're not getting choked out with your pain threshold. And you can just make decisions, learn how to make good quality decisions, trade in line with the higher time frame, start on the higher time frame, start over there first, find your trade on your higher time frame, and then make it make sense on the lower time frame. That's a great way to go about it. You guys do that, man, you'll see dramatically better results. So anyways, appreciate you guys being here. If you guys have any questions, please send them to support@tradeats.com. We're there for you. If you guys have not migrated to the new community, please do that. The other community is going to get shut down pretty soon. So everyone, please go through the migration process. If you're still in the old community, if you go just a few posts back, you'll see that Maria put in there the links to migrate. It's a simple form you got to fill out, and it immediately puts you into the new community, and it's done. So get in there. We're getting out of that one. It's going to become a ghost town here pretty soon, and I got great plans for that. It's going to be great. But we need to get you guys over there. Let's see, Mike. I see your comment. I have not gotten a migration confirmation yet. If you filled out the form, it should automatically happen. Check your spam folder if you have filled it out. And worst case, email support@TradeATS and we'll research it for you. Make sure you get in. So, but it's in the new community. Also, we did send an email out to all the members, letting them know that it is we let them know that they have the migration coming up and gave them a link to get into that as well. So to check your emails for that previous email. Also, almost forgot, we are going through a website migration today for our tradeats.com. And so if you guys go to tradeats.com and try to get into that and you see the website is down, then keep in mind it will be down for probably 2 or 3 hours tops, hopefully, while we're going to a brand new website that we've made. Anyway, we are going to be doing the migration here pretty much after this call. So give you guys a heads up, there will be some downtime there. Hopefully it shouldn't be too long. We're hoping to get it all done within like an hour, but it's just going to depend on how quickly we could get the domains to migrate and everything. And we get to that pretty much. One will have to be in the new system. The old system was running on Kajabi before, but that's all pretty much going away. So the courses as you knew them for years are all going to go away. All of our courses are going to be in the new community.